Hi, Australian expats. Jeremy Harper here. Today, I want to talk to you about getting an Australian mortgage from the UK. We're going to go through 9 to 10 steps to think about as an Australian expat and how you in the UK can still invest, refinance, and even purchase a property back home or overseas. So the first question I want to talk through is, can we borrow whilst you're based in the UK? So yes, you can, of course. There's a few myths around this, and we'll unpack some of those on this presentation. So firstly, if you're living overseas, it doesn't necessarily mean it locks you out of the property market. And so what we want to ensure is that, and we'll get to this later, is ensuring that you qualify as a resident, i.e. a citizen or permanent resident. So there's no restrictions around the type of property you can buy or refinance, and ensuring that we're working with the right lenders to take on your specific circumstances as you're based in the UK, because not all lenders are created equally when it comes to assessing your foreign pounds. So what sort of income can we use? So you may be working for a large or small business over in the UK as PAYE, as an employee, or you may be running your own business. If you're working for a employee, we need to make sure that we can demonstrate 3 months of income. So three months of pay slips. That's the pay cycle. If you're a business owner, we want to see a little bit more history. Typically, that should be sort of 1 to 2 years. That can be verified through tax returns and financial statements to verify the income or the net profit out of the business. But both can be accepted. Not all banks will accept self-employed income because it is foreign. It's quite risky in the bank's appetite. So we just have to work through the lenders that can. So what type of income, if you're an employee, can we accept? We can look at your monthly base salary. So that could just be a cash component that's paid monthly or perhaps fortnightly on your pay cycle. Any bonuses or commission as well. So you may be paid some additional income annually or half yearly. If we've got a history of 12 months of that payment, we can also take that as a type of income on your application. And then finally, RSUs. So it's quite a big tech market or industry over in the UK, particularly in London. So if you're vested RSUs or you're granted RSUs throughout your employment, and it is a large employee, so we're talking someone that's listed, not a privately held entity, then we can use that income as well for income servicing, so they can count towards your borrowing capacity. Very, very handy for clients that are working in that tech industry where a big component of your remuneration is RSUs. So as we said, employee or self-employed is something that we can both look at. Both are accepted. We just have to work through the lenders that will accept depending on the type of income that you're earning. And then how do we assess your borrowing capacity? It's a really good question. So we'd look at converting the pounds to AUD to spot rate. And then most lenders will shade back that depending on the credit appetite. Most lenders will shade back by 20% at that spot rate. Some will take a 30-day rolling average of the FX to smooth out any inconsistencies between the strengthening or the weakening dollar against the pound. And then some banks will take 90 or 100% of that income. They're typically your second tier lenders. And so, but if we want to stick with a more mainstream lender for this type of lending, we'd have to factor in a 20% haircut on that pre-tax income. So who can qualify? There is a lot of misconceptions around if you're a non-tax resident, does that impact your application? No, it doesn't. We can still lend to Australian citizens who are non-tax residents. Same with permanent residents. Just keep in mind that full non-residents, so we're talking people that have no connection to Australia. That may be someone that, let's say, for example, a German national that has no ties to Australia looking to purchase property in Australia. There will be additional surcharges and restrictions on the type of property we can buy. So that one we just need to be mindful of. And that's particularly important if perhaps a citizen has a non-citizen spouse abroad. Maybe they're looking to buy a property into Australia. And how much can we borrow? So if we are looking to purchase our first property, typically if we aim for an 80% LVR, it's going to give us a wider variety of lenders that we can work with. We can go up to 90% LVR, so you can put down 10% deposit. We will be restricted on the lenders we can use because it is foreign income. But then if you are looking to release some equity and you've got an existing property, that LVR is based on the current valuation. So we'll go ahead and order multiple valuations on your behalf on your property to get an idea around, okay, what's the market value? and then we can lend up to that 80 or 90% LVR, depending on serviceability, of course, and then we can use that sort of additional equity for future lending. And we can put that towards the next purchase. And what income counts against you? So I think this is the biggest challenge for a lot of Aussies that live in the UK. Factor in your outgoings on the overseas side. So if we take, for example, a $50,000 credit card limit or Australian credit card limit in this example, that's a 5-to-1 ratio. So that credit card limit just being open, you may have a zero balance. That's going to reduce our borrowing capacity by $250,000. So something to be mindful around what we do before the application will have a big impact on your borrowing capacity. It's not just the foreign income, it's things like credit cards, it's your general living expenses. If you've got children over there, things like childcare, nannies, any out-of-pocket schooling costs that are chunky if your kids are in private schools, we'll have to factor those in as additional commitments. If you're paying rent in London, we'll have to convert that and pay that and factor that as a post-tax commitment. So again, it's really important if you're perhaps a single applicant, you're house sharing in the UK, that we work with a lender that will just take your portion of the rent expense, because some banks in Australia will want to factor in the full rent expense for that property, even though you may be house sharing with 2 or 3 other people who are nothing to do with this application. Credit cards in the UK will also be factored in, same as car loans, and if you've got any mortgages over there as well. And then what can we do in terms of the purpose of the borrowing? So we can look at things that not just purchases or refinances to get a better interest rate, really popular at the moment, particularly on the back of the budget, looking at construction lending. So perhaps you're looking to do some renovations. They may be cosmetic renovations, perhaps doing some, a new kitchen, putting through some new paint, some landscaping on the property to increase the yield, or something a bit more substantial. That could be what you call an as complete valuation, where you might be building knock down rebuild, you might be building a duplex. We're going to get a valuation on the project to determine what's the value of that once it's complete, and the bank will allow us to lend against that end valuation, lifting up the equity position, so allowing us to borrow for that, what we think it will be complete on a more of a market basis once done. And that's really important if we're trying to see through and say, okay, this is what the property is worth now. If we add these construction value to the property, this is what we value at the end, and then we can borrow against that pending serviceability. So if you've got any questions, reach out to us. We can go through it and calculate your actual borrowing capacity, so you're not just sitting there thinking about, is this something that is doable or affordable this year? With some of the budget changes, obviously negative gearing has been discussed around not being able to access that as on established property, but just keep in mind that as a non-tax resident, from a borrowing capacity point of view, that actually has never applied to Australian expats because you're a non-tax resident. So what that will mean is it'll actually bring your borrowing capacity higher in line with the market versus tax residents. So it'll actually work in your favor. But if you have any questions, please let us know. Thank you.